the presidential election and the impact on your retirement. Next on Retiring Today. Welcome to Retiring Today. I'm Molly Nelson here with Clint Huntrods and Loren Merkle. Loren is a certified financial planner, a certified financial fiduciary, and a retirement income certified professional. And Clint is a retirement planner with a PhD. Hey guys, breaking news. You ready?
Ready.
As your seats.
Excited.
There's a presidential election.
Ooh. It's interesting.
You know, actually every 4 years.
Every 4 years?
Every
really?
4 years, there is a presidential election. And I'm going to give away something right off the top. We are not here to tell you who our favorite candidate is. We're not here to tell you who we think is better or worse or why.
That's a whole nother show.
That's a whole nother show. I don't know if you guys knew that's not part of the show today.
Oh, okay.
But what is part of the show is presidential elections in your retirement, and most specifically today we're going to focus on the stock market. We have another show planned for you where we'll talk about taxes and some of the other implications of the presidential election. But right now let's focus on the markets, because here's what I do know. Did some reading, guys. Markets are typically more volatile than average in the lead up to elections. Loren, you've been doing this for some 20 years. You've seen it happen before.
Almost every single election year. And the reason why is because elections create uncertainty. And what the stock markets don't like is not knowing what's going to happen, because stock markets are very predictive. That's what they're trying to do to gain that edge. You throw in a presidential election and all of the content and information that people are talking about with that election creates more uncertainty, which means you're going to see the stock market have bigger highs and have bigger lows throughout the course of that year.
And we are going to dive into some stats in just a minute, Clint, but I think the takeaway, which to stay real broad here at the beginning, is we're going to do some stats, and what you're going to learn is that you can't really predict exactly what's going to happen. There's a lot of things you can't control, but we're going to get you to a spot where you understand what you can control.
Yeah, and everybody has this question. Okay, we know there's an election coming. When we listen to the news, read about it, we're hearing all these different things that we feel like, wow, this is a volatile time. There's going to be movement in the market. And everybody's big question is, what does that mean for my portfolio? And so that's a question that we're fielding a lot right now in this year, as everyone's trying to figure out, okay, we know there's going to be volatility. What does that mean to me and to my retirement?
Yeah, that's great, because that is exactly what we want to try to answer in today's show. Let's talk about a few of the stats out there. I know you've got some that you want to share. One I found was that since 1932, the S&P 500 has averaged a 7% return in the 12 months preceding the election, compared with a 9% average return and out of election years. So you could make what conclusion from that one, Loren?
Yeah, I'm not sure. Is that good news or is that bad news? Or is it just a fact of what we've seen since basically the last 100 years in the market? And again, that's not something that you can really control. Actually, you can't control that at all. It's a matter of what can you control out of the portfolio and out of your retirement plan to really use that information to gain that extra edge as you're looking to make that transition to retirement.
And guys, some things have happened in recent memory in election years that contributed to some of this volatility that people often think of in election years. And first, let's start with 2000.
We go back to 2000. We're coming off the heels of really unprecedented growth in the stock market. That mid to late 90s, if you guys remember, the market was just going like this. The tech stocks were just skyrocketed. Emerging markets, international markets were just doing really well. And then the turn of the century. 2000 happens. The year 2000, the market did poorly. The year 2001, the market did poorly. The year 2002, the market did poorly. And there's a lot of things that happened. We had the presidential election year. We'll never forget 9/11. And then, of course, the dot-com bubble also took place. So we had three big events that took place that contributed, or at least in part, to what took place over that 3-year period of time.
2008, more volatility.
Yeah, everybody remembers 2008. They probably don't remember the election part of that year that happened there. They remember the housing collapse and the 401ks that you had that were cut in half. Now your 401k is a 201k, and everybody's starting to think about, oh wow, this was a huge impact. Hopefully I'm still in my working years where I'm not ready quite for retirement at that point.
And then there's 2020, the election year again, but also COVID. In March, COVID hit. The Dow fell almost 3,000 points, or nearly 13%, its largest decline ever. So here's what we know. I think the conclusion is election years can create volatility, and also other factors could create volatility. So people want to take control. And Clint, you're going to show us just how you've been helping one couple do that.
Yeah, absolutely. We just started working with a couple, and they were really concerned about volatility, and in particular, the election year volatility. And as we got started to work with them, we were able to look at their current portfolio, and this is a breakdown. On their $1 million IRA that they had, they really were working with about a 70-30 split in their portfolio. 70% was stocks, and about 30% or 300,000 was bonds. Now, as they were worried about volatility, we were able to use predictive analytics to be able to show them, here's what could potentially happen to your $1 million portfolio the way that it is currently invested. So let's say we do have volatility in a big way, and the S&P goes down by 30%. Well, we would show that their portfolio had the potential to go from $1 million, that $1 million IRA, down to $720,000, an absolutely huge impact. And in this, you'll see that the stocks portion of their portfolio is going to go down similar to how the market does. Bonds still are going to be down, not quite down as far. But for this family, they were concerned about volatility. They were particularly concerned when we showed them this to see exactly how they were currently invested. Now, when it comes to elections and election years, we can vote and that can be our impact on the election. Maybe we do a little campaigning, but we really can't control the outcome of what's going to happen in the election or how that's going to impact the market. What we can control is how our portfolio reacts to that. And so we were able to help this family in redesigning their portfolio with volatility in mind. Let's plan for it. We know it's going to happen, election year or not. And so with this breakdown in their new investment strategy, where they're a lot more strategic in their approach to risk, we have a short-term segment of their portfolio, about 20% or $200,000. With this segment of their portfolio, we really want to make sure that this is principal protected, to ensure that if there is volatility, this segment of their portfolio is not going to be dramatically impacted. They've also got more of a midterm segment of their portfolio, about 30% or 300,000. With this, they're looking to get some market appreciation and growth, but they've also got some hedging strategies to make sure that this segment of their portfolio also doesn't go down as much as the market goes down. And then they have the last segment of their portfolio, about 50%, is more of that market risk that they are taking in this segment. They're looking for that long-term growth. They're also thinking about a time horizon of maybe 10 years on this particular portion of their portfolio. So they know that they can take some market risk. They're not looking to use these dollars in the near term. But with that short-term bucket, they are looking at using those dollars in the near term. This couple's about 2 years away from retirement. So if we were to go through that same market cycle where the S&P is down 30%, we would show that in this new investment strategy that they're taking, they would be down still about $125,000, but not nearly as much as we showed them when they were in that 70-30 portfolio. And then if you look across their portfolio, they really have different segments that have performed differently. That short-term 200,000 is still short-term 200,000. They've got some fixed instruments and strategies there to get incremental growth in that segment, but they also have principal protection. So even if the market goes down, this portion of their portfolio does not. This is where they're looking to take income as they turn off those traditional working paychecks. Their midterm segment of their portfolio is down a little bit, but not nearly down as much as the market. And then they're really taking a lot of the reduction in their overall IRA portfolio in that longer term bucket. You see that went down from 500,000 to 400,000. They're not locking in that loss by selling. We know that these are dollars they're planning to use much later in retirement. And so this family starts to feel a lot more comfortable still taking market risk and looking for growth and appreciation in the markets, but knowing that they are invested with the end in mind and the potential for volatility. The difference in how they were invested when they started with us compared to now would show that they would have less of a reduction in a market volatility downturn of the S&P being down 30%. Of about $150,000. So for this family, they know volatility is going to happen, but they now are much more comfortable knowing they have a segment of their portfolio designed to deliver them income, and they know how their market is, or their portfolio is designed to perform when we go through those market cycles as we will.
$155,000 difference between when they came in to talk to you versus when you redesigned that portfolio. That is a significant difference. And what that represents to me, and I'm sure it's what they conveyed to you, is that represents hope. That represents increased level of confidence as they're looking to make this huge transition they've never made before into the retirement world. When you showed them the analytics of their existing portfolio when they first came in, and they saw that they could be down 300,000 within a 12-month poor market cycle, what was their immediate reaction to you?
They were not comfortable with that. And they didn't know. That's the other thing, that a lot of families haven't ever seen some of these analysis to see how their portfolio is likely to perform should we go through that severe market correction. And we know those are going to happen. On average, every 5 to 6 years, we're going to see a recession. We need to think about how to plan for that proactively rather than just reacting when that happens. And now they feel like they don't have anything that they can do.
Yeah, and immediately what I'm thinking about that is most people have no idea how their portfolio would react when we go through a poor market cycle until we actually go through and then they get to see it. Well, at that point it's too late because you've already suffered those losses. Your portfolio has already incurred that damage. Where one takeaway is you can actually identify how much risk you're taking in your portfolio, just like this couple did. So if you have $1 million and when this market does turn around and are you down 300,000, is that too much for you? You can actually do something about it prior to us going there. That's one of the benefits of where we're at right now with this market, is the market's up here. What a great time to take initiative to realize how much risk you're taking in your portfolio. So if it does mean it makes sense to take risk off the table, take risk off the table when the market's high. That's called taking profits. And then you can use a segmented approach like what Clint, you demonstrated on the board. And what that does is it gives them a lot more confidence in it when the inevitability of the market decrease does come into play.
Yeah, and then you feel good. You can watch the elections, you can watch what's happening around you in the world and not worry about your retirement. We're going to answer your questions next, and then we'll talk more about the presidential election and how it impacts retirement on Retiring Today.
You dream of a happy retirement, but there are some big questions to answer first. Do I have enough saved? When should I take Social Security? How will I pay for health care and keep up with inflation? Go to merkleretire.com to schedule a 15-minute retirement checkup call to talk directly with a retirement planner and get answers to your important retirement questions. The first step to your retirement starts with a 15-minute retirement checkup call.
Do I have enough saved for retirement? When should I take Social Security? Which Medicare option is best? How do I plan for inflation? Sometimes the road to retirement starts with more questions than answers. We're here to help. Join us for our upcoming Journey to Retirement workshop. Get answers and start your retirement journey with confidence. Our online workshop includes information on Secure Act 2.0 and changing retirement rules. Visit retirewithmerkle.com to register for an upcoming workshop. Your retirement journey starts now.
The Merkle Retirement Planning Team provides personable and professional expertise unrivaled in this area. They include us in every step of the planning process. The peace of mind provided to us by the Merkle team allows us to fully enjoy this special time of our lives. Instead of feeling snakebit, we feel confident that with the Merkle Retirement Planning Team at our sides, we can navigate any challenge that comes our way.
Merkle Retirement Planning. Your retirement starts here.
Welcome back to Retiring Today. I'm here with Loren Merkle and Clint Huntrods. It's time for your journey, your questions. This is when we answer questions from you. These are questions that we've got during our online Journey to Retirement workshop. Today's question is, will Social Security go broke before I retire? Clint, you guys hear this a lot.
Yeah, everybody wants to know, we're talking about the market and the election and volatility. One of the other big questions we continually get related to legislative changes is what's going to happen to Social Security? Is that benefit going to be there when I need it? Or what kind of changes could happen? There's been a variety of proposals that have been out there. Most of those haven't been able to get passed. Part of the reason it's relatively politically unpopular, as we're talking about the election and politics, to cut Social Security. If you think about that baby boomer voting bloc, they are going to vote with their feet and make an impact to ensure that their Social Security is protected.
Yeah, and that's a good reminder that this kind of ties into today's episode, which is about the elections, because the people who are elected to go to Washington, D.C. are the ones who make the rules about Social Security.
And there's been a lot of fodder about what those rules really should be, and it does get heightened in an election year as there's a lot of talk about these types of topics. My overall thought on Social Security is that it will be there in a substantive way for most of the people who are age 55 and above. And when we look at all the different options that people have when it comes time to electing Social Security, there's a lot of other factors that go into it, as opposed to Social Security is going to go broke, or in the year 2033 or 2034, Social Security payments are going to get cut by 25%, because that's what's being talked about. There's not a lot of political expedience on either side to make that happen, and there's so many different things that they can do to shore up Social Security to make sure that it is there in a big way for those who are on the cusp of retiring or already retired. Now, our kids, maybe even for us, Social Security could look quite a bit different, and there's proposals that have even been floated about what that could look like as well.
Loren, you're not saying that lawmakers are kicking the problem down the road, kicking the can down the road, are you?
We never do that, right? Budget talks, nothing ever gets kicked down the road.
Right.
We still have a number of years left before we get to that 2033 and 2034. And just to add a little bit of clarity around what those studies are talking about is Social Security is by and large pay as we go. There's payroll taxes that all of us pay into that does fund about 75% of the annual Social Security need. And then over the last couple of decades, we've built up reserves because we haven't spent paid out as much in Social Security as what has been taken in. And those reserves are what is predicted to be gone by the year 2033, 2034. And then it's the pay-as-we-go system in true form that is going to continue to pay Social Security benefits. But again, there's so many different things that can happen that I believe that Congress is going to act at some point between now and then to make sure that people continue to get paid.
Yeah, they'll either raise the retirement age, they might expand Social Security payroll taxes, the income limits for which are taxed could increase, or they might reduce benefits for higher income earners. Just some of the recent proposals that have been out there. But we do know for people that are getting ready to retire right now, so that could be you. You could be getting ready to retire soon, in the next few years. You're looking at electing Social Security, and it's a big election for a lot of people, Loren, 25 to 35% of their retirement income.
And if we add up the monthly payments over the course of one's retirement for a single individual, it could equate to over $500,000 a lifetime income. For a married couple, over $1 million. So it's a big question of what is the right option for you with Social Security. In the online Journey to Retirement workshop, we go through a number of different options for our hypothetical pre-retiree couple, John and Sue, and you see what their goals are, you see what some of their different Social Security options are, and more importantly, you get to see how they work through which of those options is going to be the right option for them, and it ends up equating to over $80,000 of additional lifetime income just from Social Security.
Yeah, it's interesting because I think sometimes, Clint, people kind of get three election strategies in mind, full retirement age. You could first elect at 62 or wait till 70. But we see in that online Journey to Retirement workshop, there's a lot more to choose from.
Yeah, the average married couple has up to 81 different options to select from. And it's really important. You've paid into this for your working career. You want to make sure you're thinking of it kind of like an asset, similar to an IRA or 401k. How do we maximize this and maximize that return over the course of your retirement to ensure you're getting the most out of what you have invested in during your working career?
You heard Loren say it, 80,000 extra dollars out of Social Security. You need to see how John and Sue do this. It's pretty eye-opening. You can register for our online Journey to Retirement workshop by going to retirewithmerkle.com. Then what you'll do, there's some dates and times you can choose from. Choose the one that, of course, works best for you, and then get ready to go on a journey to retirement. You'll learn about Social Security and much more. We've got more to talk about when it comes to the presidential election, your retirement, next.
Do I have enough saved for retirement? When should I take Social Security? Which Medicare option is best? How do I plan for inflation? Sometimes the road to retirement starts with more questions than answers. We're here to help. Join us for our upcoming Journey to Retirement workshop. Get answers and start your retirement journey with confidence. Our Our online workshop includes information on Secure Act 2.0 and changing retirement rules. Visit retirewithmerkle.com to register for an upcoming workshop. Your retirement journey starts now.
Anytime I have even the smallest question about my accounts or what effect the latest tax law might have on my situation, the Merkle Retirement Planning Team is always there and quick to help. I'm so glad they treat you like family. I'm so happy to have such an excellent team working for my future and ensuring I do the best to achieve my financial goals.
Merkle Retirement Planning. Your retirement starts here.
Do you wonder if you have enough saved for retirement? Will your money last as long as you do? Will taxes, healthcare costs, and inflation derail your retirement? Get answers. Schedule a 15-minute retirement checkup call today. We can cover a lot in 15 minutes, including strategies you can implement now to start your retirement journey. Schedule a call at merkleretire.com. The first step to a confident retirement starts with a simple phone call.
Welcome back to Retiring Today. I'm here with Loren Merkle and Clint Huntrods. We're talking about the presidential election in your retirement. We're going to go back to volatility. You showed us how you help a couple plan for volatility. Presidential election years, we know there's more volatility than normal. And a lot of times, Clint, people want to blame it on one party or the other.
Yeah, everyone wants to know who's going to win, and then what is that going to mean for my retirement? And a lot of people have these certain beliefs. If it's a Republican win in November, it's going to be a certain outcome. If it's a Democratic win, it's going to be a certain outcome. This chart that we're pulling up on the screen to show you here is reflective of the S&P return over the last about 70 years. And if you look close at this, you'll see the returns are coded red for Republican president in administration and blue for Democratic president in the administration. And what you see there as you look at it is it's almost equal on the returns that are positive and also the returns are negative, especially those that are very, very far down below that line in negative returns. And so really you can anticipate volatility. The market's going to continue to do what it does, regardless of really who is likely into office.
So we look at over the last 100 years, the results of what the market has done, regardless of what president has been in office or what party has been in office. You can see the blue, you can see the red. What the one constant is the market just continues to ride up regardless of who's in the market. And that's the power of being in the market, not trying to time the market, but the time that you're actually in the market. And as long as we use the markets, the stock and the bond markets, how it is designed, then we should fare well over the course of a long time. And that goes back to the chart that you showed, or the example that you gave on the board. Is here's a strategy that can work regardless of all these things that you can't control. So it's fun to talk about who's going to win, who's not going to win, what are the consequences. And Molly, to your point, there's plenty of blame to go around for everybody.
Sure. That does happen in Washington, doesn't it?
But you can't control what happens to your portfolio, which means you can control the income you receive in retirement from your portfolio, and that will influence the lifestyle that you can have over the course of your retirement as well, which is what most people care about.
And you saw this play out. You've seen this play out over your career in presidential election years and just recently in March of 2020 when there was so much volatility.
We've seen so many downturns over the course of our career. 2020 was a big one. And the thing about 2020 is there was a lot of crazy stuff going on in the world that nobody was happy about. But what we saw that volatility as an opportunity. And so what we were doing is we were working with our families about the specific strategies they could incorporate to take advantage of that stock market volatility. What everybody says as far as how to make money in the stock market is buy low, sell high. It's just very few people find ways to do it, especially as you get so close to retirement and then in retirement. But there are, in fact, many strategies that you can incorporate, and that's what we saw in 2020. And by the end of 2020, from a financial standpoint, our families were in a much better position because we implemented these strategies to take advantage of those market discounts.
Yeah, we've talked about 2020 several times here inside the Merkle Retirement Planning walls, and none of the families that we work with came out of retirement. None of the families were called and were in a huge panic when they saw didn't the Dow drop 30% in the weeks following the S&P's, or the S&P dropped some 30%. They weren't calling in a big panic because they had done just what Clint had done with that family. They had put together a retirement that wasn't going to drop that much when this stuff happens.
Yeah, in March of 2020, the S&P dropped 34% over a 22-day time frame, and there was many conversations that we were having with our families, but those conversations were us picking up the phone, calling our families and saying, hey, you remember the go time strategies that we were talking about in 2019? Guess what? It is go time. And they were excited. Now, they weren't excited about all the trauma in the world, but from a financial standpoint, they were excited things they could do to enhance their financial situation in spite of all the negative. And what a great way to look at your portfolio in an opportunistic way. Imagine going through the next big downturn in the market and not having to worry about it because you have a plan in place and there's action items you can take to enhance your own position for when this market inevitably does come back up.
And it includes a whole plan of things that have to work together. And our online Journey to Retirement workshop will give people a really good glimpse into what this whole process looks like and how you can put together a portfolio with volatility in mind.
Yeah, the online Journey to Retirement workshop is perfect for those who are 55 years and older. You know, you're kind of on the doorsteps to retirement, and you're starting to realize that the investment plan that maybe you've been utilizing during your working careers is not going to be enough as you start to see more moving parts. You think about your income plan, you think about tax planning opportunities, and back to the example that we looked at before, you want to make sure that your investments are going to be protected and you have opportunities in downturns rather than feeling like you're going to be depleting your portfolio at a faster rate. And in the online Journey to Retirement, you see some of those different components of a comprehensive retirement plan all come together for a particular couple that we follow to and through retirement.
Yeah, who should sign up for the online Journey to Retirement workshop?
If you're 57 and above and you're looking to retire and you want to know what kind of strategies you can incorporate within your overall plan, and you want to learn about what retirement planning is. Well, we talk a lot about retirement planning, but it's such an abstract idea. And when you break it down, there's a lot that goes into what it should be. The online Journey to Retirement gives you concrete information that you can take away and implement almost immediately to create and implement a plan that will work for you.
Go to retirewithmerkle.com to sign up. This is Retiring Today. Thanks for watching.
Do I have enough saved for retirement? When should I take Social Security? Which Medicare option is best? How do I plan for inflation? Sometimes the road to retirement starts with more questions than answers. We're here to help. Join us for our upcoming Journey to Retirement workshop. Get answers and start your retirement journey with confidence. Our online workshop includes information on Secure Act 2.0 and changing retirement rules. Visit retirewithmerkle.com to register for an upcoming workshop. Your retirement journey starts now.
You dream of a happy retirement, but there are some big questions to answer first. Do I have enough saved? When should I take Social Security? How will I pay for health care and keep up with inflation? Go to merkleretire.com to schedule a 15-minute retirement checkup call to talk directly with a retirement planner and get answers to your important retirement questions. The first step to your retirement starts with a 15-minute retirement checkup call.